Most retirees don't realize they're walking straight into a tax trap. Not this year, but 10 years from now when those RMDs hit. And by the time they see it coming, the window to do anything about it is already closed. The retirees who pay the least in taxes over their lifetime, they're not just managing this year's tax bracket. They're engineering their tax brackets years, sometimes even decades in advance. And the single most powerful tool for doing that is something that's called bracket filling. If you've got significant pre-tax savings, this is one of the most important retirement planning concepts for you to understand. Hi, I'm Mark Wisniewski, president of Southern Incomes. I specialize in tax-efficient retirement income planning, and today I'm going to show you how systematic Roth conversions done strategically can help you stay ahead of required minimum distributions and potentially save your family hundreds of thousands of dollars in lifetime taxes. No doubt about it. Now, this isn't a loophole, and it's not even being aggressive. It's just the intelligent use of existing tax code. If you find this helpful, please like and subscribe. And if you want to map out a strategy for your own situation, book a complimentary call with me using the link in the description. Part 1, why the pre-RMD years are just so valuable. Let me start with the foundation because everything else builds on this. When you retire, let's say at 62 or 64, something interesting happens to your taxable income. If you're not yet drawing Social Security, not yet taking those required minimum distributions, and of course, you're no longer receiving that paycheck, your taxable income may drop to the lowest level it's been in 30 or even 40 years. And for a lot of people, that feels like relief. And it is. But here's what most people miss. That low income period, it's not just a break, it's an opportunity. Think of it like a tax valley. You're standing at the bottom, income is low, brackets are wide open, and you have more control over your taxable income than you'll ever have again. But on the other side of the valley is a cliff. And it arrives at age 73. That's when the IRS requires you to start pulling money out of your traditional IRAs and 401ks, whether you need that money or not. A $1.5 million IRA at age 73 is going to make you pay an RMD of approximately probably $55,000 to even $60,000 in the first year. And that number climbs every single year after that. So here's the strategic reality. You have a window, potentially maybe 8 to 12 years, during which your taxable income is low. Your tax brackets are wide open, and you have complete control over how much income that you're going to recognize in any given year. That window is where bracket filling lives. And once RMDs start, a meaningful part of that control just goes away permanently. Part 2, what bracket filling actually means. Let me break down the concept simply because the term bracket filling can sound more complicated than it actually is. Every year, the IRS gives you a certain amount of room in each tax bracket. For a married couple filing jointly in 2026, the 22% tax bracket runs from $100,800 up to $211,400 in taxable income. The 24% bracket runs from there up to $403,000. Now, don't worry, you don't need to go out and memorize all those figures. Just understand that every year your bracket has unused space. And if your income isn't filling it, that space is just quietly going to waste. Bracket filling means deliberately converting just enough of your traditional IRA to Roth each year to bring your taxable income up to, but not over, the top of your target bracket. You're using that empty space to move money from a tax-deferred account where it's going to be eventually taxed at some unknown future tax rate into a tax-free account where qualified withdrawals can be completely tax-free. Every dollar you convert today at 22% is a dollar that will never face a higher rate that arrives when those RMDs start stacking on top of your Social Security and your other income. Now, you're not eliminating the tax, but you're choosing when and at what rate you're going to pay it. And you're choosing it during the years when that rate is likely the lowest it's going to be. Part 3, the real cost of doing nothing. I want to spend a moment on what the alternative looks like because I think it makes the strategy clearer. Let's say you're 65, you recently retired, your taxable income is $70,000 a year, married filing jointly, and $1.8 million in a traditional IRA. Now your instinct is to just leave that money alone and let it keep growing. Don't trigger any taxes that you don't have to. And that instinct is certainly understandable. But here's what's quietly happening. That $1.8 million is growing tax deferred every year, which means the future RMDs are getting larger each year. At 73, your first RMD might be $70,000 or $75,000. At 78, it could be $90,000 or more. Layer that on top of Social Security, let's say $48,000 a year for the two of you, and now you're looking at over $130,000 in taxable income before you even made a single discretionary withdrawal. That could push you solidly into the 24 or even the 32% bracket, trigger taxation on a higher portion of your Social Security benefit, and potentially push you over the IRMAA Medicare income thresholds, which can add hundreds of dollars per month to your Medicare premiums. Meanwhile, back at age 65, you had years of room in those lower brackets sitting completely unused. Your tax code was offering you a lower rate. You declined it without even knowing what was on the table. That's the cost of doing nothing. It's not dramatic in any single year, but compound that over 20 or even a 25-year retirement, the difference in lifetime taxes can be enormous. Part 4, how to think about the conversion amounts each year. So, how do you actually decide how much you're going to convert in a given year? Let me give you a simple framework. Start with your current taxable income. That's going to be everything you're already making from Social Security, pensions, dividends, any other income sources. Then identify the top of your target bracket. The gap between your current income and that ceiling is roughly your conversion capacity for the year. So let's look at an example. If your household income is $80,000 and the top of the 22% bracket for married filers is $211,400, you may have the capacity to convert up to $131,000 in that calendar year while staying within that tax bracket. Whether that's the right amount or not, well, it's going to depend on, whether you have liquid assets outside the IRA to pay the taxes, your Social Security timing, your projected RMDs, and of course your overall legacy goals. This strategy has to be sized correctly for your situation. Converting too much in the wrong year can just backfire on you. The goal is to convert the right amount in the right years at the right rate, so that over a 5 to 10 year period, you've meaningfully reduced the size of that pre-tax account that's going to generate RMDs that you have to pay later on. You've built a substantial tax-free Roth balance, and you've lowered your expected lifetime tax bill. One important note here. Ideally, you want to pay the conversion taxes with money outside the IRA. So a savings account, a taxable brokerage account, or just cash reserves. If you withhold from the converted amount itself, you're shrinking the dollars that actually make their way into the Roth, which is going to reduce the long-term benefit that you enjoy from this strategy. Part 5, what this does for your family beyond your lifetime. There's one more dimension of this that I don't want to skip, because for many of the families I work with, it becomes the most compelling reason to act. Under current law, when your children or your other non-spouse beneficiaries inherit a traditional IRA, they are required to fully distribute and pay tax on that entire account within 10 years of your death. That's the 10-year rule under the Secure Act. Depending on your children's income, they could be pulling those inherited distributions right in the middle of their peak earning years, paying 32, 35, or even 37% on dollars you could have converted at 22 or 24% a decade earlier. A Roth IRA passes to your heirs income tax-free. The same 10-year distribution requirement, but qualified distributions carry no federal income tax liability. So, when you think about bracket filling, you're not just managing your own tax bill. In many cases, you're protecting your family from, well, a burden that was completely avoidable. Here's the bottom line. If bracket filling is something that you've never modeled before, if you've never sat down and mapped out how much room you actually have in your tax bracket, how many years that you have left in that window, and what a systematic conversion strategy could save your family over time, that's exactly what we build out together in a call. Come see what this looks like with your numbers. The link is in the description. I'm Mark Wisniewski with Southern Incomes. Thanks for watching, and I'll see you in the next one.